Work. I'd like to invite our panel for the next session up to the stage, please. This morning, our panel is being moderated by Ante Urvas, who is the Associate Director of FinFund, an experienced finance professional currently heading the FinFund's financial institutions team. He's had a versatile career in international commercial and investment banking prior to joining FinFund in 2012. He will be moderating our session for the next 45 minutes. That's attracting investment into Africa. What is it really that investors want? Thank you very much for your attention. Auntie, over to you. Yes, I have microphones for you.
Yes, very good morning, everyone, and welcome to this interesting panel. So I have the honor of moderating the panel with distinguished and experienced panelists representing insurance, banking, private equity, development finance, and media. So maybe I start from Patrick. So Patrick is a very experienced media professional, so that he's been leading some of the key media covering Africa, both journals. He's done documentaries and many interesting things, having focus on economic, political, and other interesting topic. So thanks, Patrick, for joining the panel and giving your input to us about this theme. And then we have Agnes. Welcome, Agnes. Agnes comes from Proparco, which is one of the leading European DFIs from France. And Proparco invests, is it about 2 billion each year? And financial institutions is the biggest sector for Proparco. And Agnes works as a senior investment officer covering Africa and Middle East. And previously she worked in Proparco's South Asian operations in Bangkok, originating investments in Asia. Warm welcome, Agnes, to you. And then we have William. William is a very experienced private equity investor in Africa, so that he spent a lot of his career leading one of the leading private equity houses in Africa. He has extensive board experience with several FIs, and he's also worked for such well-known institutions as General Electric and Merrill Lynch in the past. And William is currently working on an interesting venture which is bringing investment in a new manner to African continent, and William will probably share his questions, show his views from that point of view. And then we have Philip. Philip is having a strong SME and microfinance banking background. So he's currently the CEO of Baobab, one of the largest microfinance groups working in Africa and Asia. And prior to that, Philip was heading the SME business of Equity Group in East Africa. And he's been also working as CEO of several microfinance SME banks, for instance, in DRC, Kosovo, and Georgia. And also who has worked at EBRD, covering investments into Russia. So very rich experience on SME and microfinance banking. Welcome. And then we have Mikir. Mikir has a heart and passion for insurance, so that Mikir has worked for different senior executive roles in banking and insurance in Africa, in India, and also in London. And in today's panel, Mikir will share kind of the insurance angle, which is maybe a little bit neglected compared to kind of the banking that has received the attention more than the insurance. And we will start with the first question, that what do investors want? So we will address this question first, and each panelist will share their views on that question. And then we'll have maybe one or two questions to be shared from you, the audience. And then we'll go to the second question that is how to attract investors. But we start now that what do investors want? And maybe, Patrick, you could start. Over to you.
Thank you very much. Welcome everybody. It's good to be here on a very typical London morning. Unfortunately, the capital markets have not been raining on this country in the last few weeks, and they haven't been raining in general on the developing economies of the world. I don't know whether we can count what's happened in Britain as part of the developing world, but it's beginning to look like that. I think Larry Summers talked about submerging markets when he was referring to British economic policy at the moment. I mean, the reality is that in the last 6 months, $50 billion has left the developing economies in the world. And that's right across the board. That's the tiger economies of East Asia, South Asia, and the whole of Africa, and Latin America. And that's just the beginning. So I think we need to get real about what's happening in the world before we can deal with the issue of getting investment into Africa and into the most likely sectors in Africa and what needs to be done. After that sort of flash of gloom, I would say, give you one good data point. Mobile money transactions in the world are worth over $1 trillion a year now. And out of that $1 trillion, 2/3 of that $1 trillion are happening in Africa. So what we are seeing is the leapfrogging potential of African economies. And we saw this, a very good model, I think, when it comes to looking at the financial sector in Africa, is the telecom sector in Africa. 20 years ago, I think many of you are from South Africa, a pioneering company called MTN looked at the Nigerian market and said, wow, 180 million people? A lot of those people must want phones. And all the traditional companies in Europe were saying, nah, they can't afford it, mate. Don't even think about it. Now MTN is a market leader, not just in Nigeria, but across the continent. But its Nigerian franchise is the most profitable franchise it has. Now, at the same time, really exciting things were happening in East Africa with Safaricom and M-Pesa. And that model of mobile money has been replicated right across the continent. And Kenya, and now we're seeing countries such as Rwanda, Ghana, Nigeria, and even South Africa. South Africa, in this case, has been the laggard on mobile money, beginning to revolutionize the picture. So I think part of the answer to your question is people are looking to Africa for innovation and ways of leapfrogging the traditional forms of economic development and economic structure to find something that will work much faster. And I think if you move that across to other sectors, I think the next big growth sector in Africa is going to become the power sector. And I think we're looking at the same sort of dynamic in the power sector as we saw in the telecoms sector. We're heading, I think a month's time, we're heading to Egypt for COP27. And we're assured that there's an absolute dearth of bankable energy, green energy projects in Africa. That's partly because of the limitations of the financial structures in Africa, but it's partly because of the fairly dull things like project preparation, feasibility studies, and so on. So if you look actually at the micro level in Africa, a lot of companies are raising funds at local level and regional level for very good off-grid solar projects. And it's that sort of innovation that is reshaping the African economy. So perhaps I could just end with 2 points. I think we've got to get projects right and project preparation right, and that is key to getting people to come in. And that requires the multilateral development banks, it requires funds from places like this country, from the US, from Canada, France, EU, and so on, and also sorting out currencies. And somehow we have to, when the World Bank meets and the IMF meets this week in Washington, they have to have a really hard discussion on currencies. The Federal Reserve's headlong rush to push up interest rates is devastating currencies right across Africa. And we need some sort of currency consensus on this. Otherwise, we're going to see what happened in the 1980s all over again. Paul Volcker dealt with inflation by whacking up the Federal Reserve interest rates, and Latin America and Africa entered into recession and then a debt crisis. We can't afford for that to repeat itself. Thank you.
Thank you very much, Patrick. And now, Agnes, we give the floor over to you.
Thank you. Yeah, maybe I'll give an answer, a bit more precise answer of what exactly investors want, because I'm speaking as an investment officer at Proparco, which again is a development financial institution. So when it comes to financial institutions, and I fully agree with you that we have to, as a development finance institution, we have to look at new business model, and we actually are, because since 2018, we have broadened our investment to VC, to venture capital segments. So we are looking at this type of new business model that can improve and increase the financial inclusion of African populations. But if we just go back one step before and just focus on traditional banking sector, I would say that particularly in Africa, and as a DFI again, we would have three main investment criteria that are very important to us. The first is good governance, and I think that applies from fintechs to banks and also insurance company and more traditional FIs, because what we saw is that even if you have a good leadership team with a clear strategic vision, at the end of the day, if the governance is not solid enough, then the company that you are looking at might not grow to the extent that you wanted. And we are actually at Proparco more and more focused on this type of topics, and we now try to provide technical assistance to help companies comply with the best standards of governance. So for me, that would be the first criteria for investing in a financial institutions. Then I think, and also it goes back to the first panel that we had this morning, given the macroeconomics context and the political context in some countries, I would say that the institution that we look at needs to have what I would call a controlled sovereign exposure, to make sure that they are not too weakened in case of instability, whether it is political, macro, or economical situation. And the third very important criteria to us, but again, speaking as in the context of being a development finance institution, would be to have a clear exit path, and that would be in its large definition. So whether we invest in a sector whereby consolidation is expected in the near future, or a potential IPO to improve liquidity on the capital market. So yeah, I would say these three criteria at least for a DFI like Proparco, are the most important on what we are looking at when investing in financial institutions.
Excellent. Thank you very much, Agnes, for sharing these insights. And then, William, we'd like to hear from you that what do the investors want?
Thanks a lot. So Agnes really addressed mostly, what are the criteria for international investors, often mostly looking at equity. If you think about the liability side of the typical African banks, you have about 15% of core equity tier 1, 5% others, and 80%, which is really what I want to focus on, is really term deposits. We have to remember that most of the capital that's going to go through the banking system is going to be local capital coming from local retail, institutional investor, pension funds. Today, what's important for them is visibility, is also the ability for those institutions to absorb that capital, because if you think about insurance and pension funds, they have assets that are growing, which need to be deployed. So they're very happy when there's improved governance, there's consistencies in returns, because they have to, it's important for them from a regulatory standpoint. But what I want to give as a message is, big picture-wise, the biggest investor in, the biggest asset class, for the banks is really today the deposits, and the biggest investor for that is local and local institutions.
Okay, thank you. And now, Philip, we'd like to hear from you.
Yes, thank you so much. I just wanted to add a few comments to what the previous speaker said. I wanted to put more the focus on both what investors want, but also what companies want from investors, because you need to bridge the gap. So I speak as an operator. So Baobab Group, we're present in 7 countries in sub-Saharan Africa. We disperse about $1 billion in micro and SME loans to about 250,000 entrepreneurs across the continent every year. And of course, we are regularly in discussion with potential investors. So it's really about bridging the gap. So I think the most important for investors is to realize that, as was mentioned previously, capital markets are still very, very shallow. Capital is very fickle. It can quickly, it comes, it goes, depending on mood of investors. Right now, it's rather leaving the continent and flowing into the continent. And at the same time, it's a high-risk environment. So just this morning, there was again an article in the FT about Africa, about Mali and Burkina Faso and jihadism. And we operate in these 2 countries. Our total loan book in these 2 countries is about $80 million. So of course, what we want is from investors is to have a certain degree of risk tolerance. And I think that that's where, for example, the likes of Proparco can play an extremely important role, because they can help to de-risk certain types of investments. When private commercial investors invest together with the DFI, it somehow helps to de-risk. So that is incredibly important. Now, what I see is what fundamentally makes financial institutions successful, that's more from the operator's point of view, is basically what I define as the 3 M's, which is very similar to if you're an operator or an investor, it's basically the same. It's the macro, which refers to a macroeconomic environment, currency exchange rates, and so on, macro stability, and which is very difficult. You have some areas in Africa which are better than others. Maybe the 2 extremes are the WAEMU zone, which is relatively well managed, pegged to the euro, and the other extreme are places like Zimbabwe, and Nigeria is somewhere in between. But that's from the macro point of view. Macro is very important both for the investor and for the operator. Second one is management team. Investors want a strong management team, so that's fundamental to driving to growing a successful institution. And the third one, which is sometimes underestimated, is market share, or I would say scale. What I see in the microfinance sector, for example, is too fragmented. But the same applies for many banks on the African continent. Very often you have subscale operations. It's very difficult to have a good cost-income ratio when you're operating at subscale. So it's very fragmented. So I expect that there will be consolidation going forward. And then you will achieve a bigger scale. But one should always keep in mind that economies of scale matter in the financial sector. And when I talk about economies of scale, it's mostly at the country level. There's very few synergies of operating across countries. And I'm kind of like shooting myself in the leg, because we operate across multiple geographies on the African continent. But the truth is that there are few economies of scale, maybe a bit on the tech side. So that's the other important element, of course. Investors nowadays, of course, are very much interested by tech. Whenever we talk to investors, they always ask where we stand in terms of tech, because it's especially for equity investors, debt, of course, less so. But they try to understand where will you be in 5 years? Will you be among the winners or the losers in 5 years? So tech is definitely a very important element. Then the question of exits, this was mentioned also by Agnes, the question of the exits. Well, you know, I think there's a bit of an illusion regarding public markets and IPOs and so on, because the markets are very shallow. So it's very difficult. So one always needs to keep in mind, you know, what do we project in terms of exits? Is it more like selling to another private equity fund? Is it selling to a strategic investor? And then strategics have very different expectations also. So exits are definitely an important element for discussion.
All right, very insightful. Thank you, Philip. And then Mikir, now about insurance. We'd love to hear from that.
I think this is working. So look, if we take a step back, well, why are we all here? We're here because Africa is the least developed continent on the planet. That means we have the biggest opportunity in Africa. It means the returns available from investing in Africa are substantially better than they are elsewhere. That's why we're all here. What's stopping the money coming into Africa, and why can't we get more of it? It's certainty. It's as simple as that. It's, can you invest your money? Can you make sure that there's a regulatory regime that looks after your money? Can you get your money out? Can you make returns in a manner that allows you to take the cash back when you need to take the cash back? Can you have an environment where governmental intervention doesn't stop your returns or makes your investment invalid? That's what's really stopping the investment. Otherwise, everybody would be rushing to invest in Africa. That's the real issue that we have. And so governments have their role in making sure that they make their environment more sustainable, that they don't interfere, that they don't sequestrate assets when they feel like it. The reality is the perception of this risk is substantial in Africa. And that's what really does inhibit the flow of cash, whether it be in the financial services sector or anywhere else. So actually, that's what led me and the management team to set up Africa Specialty Risk. That's precisely what we do. We're an insurance and reinsurance company that de-risks investment into and across Africa. Now, we do what we do, and I can tell you, last year we helped de-risk $3.4 billion of investment into 16 countries in Africa. However, that's us. We're a new business. We started off with great funding, including from many people in this room as well, so I'm always thankful for that. But reality is, it's not enough. We do need the likes of Proparco and the other DFIs to work with us in a sort of concerted manner to provide these de-risking opportunities in order to provide the certainty that's required for investors to make that investment into Africa. We know that they're going to get outsized returns from investing in Africa, but at the moment we don't have a choice. With the continent developed as little as it has been, reliant on imports when it shouldn't really be, because it's the home of many natural resources and minerals. You know, in terms of everything you look at, whether it be refining the minerals in Africa, so you're not shipping them across the world, and all that does to the environment, and in addition, you retain the value added in Africa, all the way to providing the financial services that are required locally for investors to make that leap into building their businesses in Africa rather than exporting into Africa. So there's a lot we can do to do this, but we do need a concerted effort to do that. And I think it's possible. I mean, we're living proof that it's possible.
Thank you, Mikir, for those encouraging words. I think now we could take one or two questions related to this first topic. Is there someone who could actually...
Thank you. My name is Reginald Masawe from Tanzania. My question actually is just an expansion of the same question. Looking at what investors want today, if we compared with what they wanted 5 years ago or 10 years ago, and what would they actually want in the future?
So what do investors want compared to 10, 11 years ago? Was that the question?
That's just the background, but the question is the future. I'm looking at what would they want in the future. Because the point that's been raising is what we have been hearing about a couple of years. What is new, what is different.
So anyone who's like to pick the one, this one?
Well, I guess one of the big pointers in the future is going to be demography, right? So we're now looking at a continent of 1.34 billion, and the UN population boffins say by 2050 it will be 2.45 billion. Nigeria will have a bigger population than the United States. So first of all, they're looking at a massive increase in market. They're also looking at the biggest working age population in the world on the continent. I'm talking the African continent, all 54 states, right? So I think first of all, they're looking at a strategy to get in there, and investors in Europe are alarmed at the number of other players that are coming into the African market from the East and from the West, from Brazil, from India, from China, from Taiwan, from Japan, from Korea, and so on. So, I mean, I would say they're looking for competitive advantage in the African market, whether it's in the financial sector or whether it's in the big demand for private sector investment, which has got to be in infrastructure. And I think what people are taking out of that is the important role that African financial institutions and international financial institutions can play in securitizing and guaranteeing investment into the infrastructure, bearing in mind that most of the investment in Africa's infrastructure, the really big demand stuff, the ports, the roads, the electricity sector, and so on, and water supply is going to be provided now by private sector investors. And it's not just private sector from Europe, but also from East Asia. Increasingly, East Asian and South Asian companies are looking at infrastructure opportunities, but those have to be structured by financial institutions. So I think that is the big opportunity ahead of us. 2.45 billion people looking for infrastructure development. And that's got to be the biggest opportunity in the world at the moment.
Right, I think there's Mikhail would like to address this question as well.
Yeah, well, I'm from Kenya, so I look across the border and I see Tanzania as a huge land of opportunity. You have land for agriculture, you have minerals that can actually alleviate a lot of the problems around the world as well. So even before we get to where the population is going, it's the ability to build a business without interference in a positive environment, governmental environment that allows you to grow that business, allows you to build employment and the skill set locally, and allows you to exit without interference as well. So that's what investors are looking for. It's what we're doing. I've been to Tanzania, I've been discussing many things with the government there as to how we encourage that going forward. It's not just Tanzania, it's most of the countries in Africa have the same opportunity. It's how we now attract the investment to actually make sure that it comes in and it develops the continent. Infrastructure is very important. Clearly, whilst Tanzania has the land, it needs the irrigation to make sure that it can actually cultivate the land as well.
William.
Yeah, I'll give a slightly different twist to the answer. I think the most important things for you is to focus on, what type of capital you need for your business to grow, not what the investor wants, because what the investor wants is sometimes extremely fickle. If you look at Côte d'Ivoire or Benin, 18 months ago, international investor, were saying that, the yield on the bonds, should be 4%. Today it's 15%. Not much has happened in Benin and Côte d'Ivoire. There's a lot of, macro shock, but it hasn't really impacted Benin and Côte d'Ivoire. But investor sentiment has completely changed. And, you're in a situation where, the perception of your risk has completely changed. So, for you to develop a business, in the long term, you have to focus on what type of capital you need and also who are the investors who really understand your business and who will be with you along the journey. And that's most likely people that are very close to you, both mentally and geographically speaking.
Thank you, William. And I think we have a new question over here, please.
Good morning. I'm Shamin Sukia, Managing Director from Mauritius, Belgium Capital. So as an aside, I would like to understand a bit about, we're talking about investments and investors. I'd like to understand a bit about, where is the place of impact investing, sustainability investing, and ESG, etc. Thank you, especially for Africa.
So what is the place of impact investing and
Sustainability, ESG.
And ES for investments? Right.
Yeah.
So Agnes, would you like to start?
Perfect.
Yeah, I mean, I think my answer will be a bit biased because obviously for DFI the impact angle is as important as the return angle and the risk angle. So at Proparco, when we invest, we'd like to say that we have this triptychal three-legged way of seeing things. So you need to balance risk, return, and impact. And for us, we don't only see impact as just being a nice to have or something that is just positive for the population that at the end benefits from the financing product of the FIs in which we invest. We also see that as a booster for growth. So we are more and more focused, and I think it applies for all DFIs actually, on climate change related topics and also gender focus, because we realize that actually when you bring, for example, equality in financing, so trying to foster financing into women-led companies, you actually see that it's a real path for growth for institutions. So yeah, I would say that at least at Proparco, impact is obviously at the heart of our strategy. Financial inclusion is still one of the key topics, whether it is development of product design for the bottom 40 and things like that. But I think that maybe these past few years we have also focused on other products than just credit. I think overall everybody was very focused on how to increase financing capacity of banks and support them into financing more and more institutions, SMEs and individuals. But now we are also trying to look at products that can increase population resilience. And so back to what Mika was saying, like insurance product is very key because it's not only about credit, it's also about how increasing the resilience of population. So insurance and saving products, things like that.
Thank you. I look forward to working with Proparco much closer then.
Perhaps I could echo Agnes a bit from FinFund, so that impact is very important for us. It is impact and return that needs to be balanced. And maybe one example, practical example, usually we don't invest in bonds, that we rather do bilateral loans and invest equity. But we have done two exceptions. Last year and this year we have invested in two bonds issued by African financial institutions. And why? Both of these were sustainable bonds, so that they had a framework implemented which determines that how are the funds going to be used, and there's also a very clear reporting requirement and system that will be put in place about how the funds are utilized, and also to some extent that what is the impact that will be generated. And we invested in first such bond issued by a large African bank, and this is one example of how or why sustainability and impact is very important, and how through innovation you can actually attract investment into Africa.
And just to add to that, any investment that comes into Africa will have an impact, and that's really important to understand. So our key thing here is to encourage the investment to come in. It will have an impact. You will have training. It will have a social impact. I mean, look, we have lots of questions. As an insurance group, we have lots of questions about ESG, and people say, oh, do you do coal? Yes. Yes, we do insure coal-powered power stations. And the reason we do that is only 40% of the population in Africa has access to electricity. So when a European asks me that question, I always say, can you go away and live without electricity for 48 hours and come back to me? And then tell me it's okay. However, what we do though, for all new insurance de-risking that we do, we are actually seeing virtually everything we do is renewable, it's impact, it's sustainable. So I think in a period of 10 years, we'll see Africa as a continent more powered by renewable energy than any other continent on the planet. The gas and the oil that we find in Africa is actually going to Europe and the West. So we must always remember that, and we must always remember that Africa only generates 4% of the greenhouse gases globally. So whilst we suffer the most, we are also using our resources to continue providing the West with the support they need from those fossil fuels. Sorry, you got me on a little bit of a soapbox about that.
Right, and I think Philip also wants to address this important question.
Just, I agree 100% with what Mikir just said. In a way, most investment on the African continent is somehow impact related, for the simple reason that if you look from a purely commercial point of view, the risk-adjusted returns on the African continent are not very good. It's as simple as that. I mean, a pure commercial investor would invest in the US, probably mostly, and maybe in some other parts of the world, but not really in the African continent. Really? Because it's a risky environment. We see that, we attracting investment is mostly DFI related or DFI funded through some private equity funds, but always a big share of DFI money somewhere. And there's a good reason for that, because precisely it's very impact related, and it does not apply only to microfinance, but you look at the healthcare sector, you can look at the insurance sector, you can look at the electricity sector, infrastructure, transport, whatever. The only exception maybe is the mining industry. In the mining industry, you probably can make a ton of money without focusing too much on impact on the African continent. But other than that, it remains a high-risk environment. That's why the impact consideration is so incredibly important.
All right, did we have one more question? Yeah, please share that.
Hi, Douglas Rawlings from Moody's Investor Service. It would be quite interesting to hear the view of the panelists. Agnes, you touched on it in terms of technical assistance and governance, but the role that credit ratings could play when it comes to bringing capital to the financial sector in Africa.
Sorry, I'm not sure if we were able to. Can you repeat, please, because we don't hear very well because the loudspeakers are your way. So
Agnes, you touched on sort of technical assistance, and I think that that's quite important. Is that it's not only bringing capital to the continent, but it's also trying to create the conditions that are fertile for continent coming in. So it'd be quite interesting to see when you look at, as Proparco, when you're looking at sort of investment opportunities, but more broadly, because I mean, you're all players across the continent, the role that credit ratings can play in terms of trying to bring more capital, ticking some of these sort of the governance boxes that would bring capital in as well.
I think it's very important topics. So today, if you look at, credit rating play a big role in, sophisticated market because it gives, benchmark that are commonly used, and that, give, let's say, people, regulators, society confidence that, liquidity and long-term investment can be deployed. The biggest problem you have today in African markets is, one of the biggest problems, and especially for the banking sector, is really credit ratings, because you have institutions, banking institutions that are highly profitable, but they still have, very poor credit ratings because they're being told that, they belong to, whichever country that is not very well rated, and they can go above that rating. So the credit rating today, the way it's structured, it's something that prevent a significant amount of capital coming inside Africa as a continent. It has another side effect which I think is even worse, which is the fact that today you don't have credit rating for short-term facility. So if you think about all the short-term effects that is belong to all institutional investors in Africa. There's no credit, so you have credit rating for Eurobonds, but you don't have that for short-term products. So they don't have any, let's say, insurance system where there's a regulation where you need a credit rating to be able to deploy capital in countries. That capital, the short-term capital will technically get out of the continent just because of the side effect of the international credit rating. So credit rating is a really, really significant effect. The way it's done today, it's extremely detrimental to African country, both on the sovereign and the corporate side, and it really needs to be addressed because even if you take a country like Nigeria, Nigeria has most of its financial institutions that are rated, but they all have the same rating. So you can't really use the rating to discriminate, and you have to discriminate so that the investors are comfortable allocating capital. So it's a big issue, and you're really right to point it out.
I think then we have Patrick and perhaps Agnes as well, and Mikir, quickly, please.
A couple of things. Firstly, on the ratings agency, 100% agree with you. We have a situation in the world, 95% of ratings, financial ratings, are done by 3 different companies. Right. No disrespect to Moody's, who I understand are sponsoring this conference, but it's an unsustainable situation, and it gets bad results and it gets bad analysis because, with the best will in the world, these ratings agencies do not have the people on the ground who understand what is the dynamics of these economies. Moody's is one of the best because it has a South African office. The rest of the ratings agencies don't have full-time staff in Africa. They don't understand the markets, they don't understand the dynamics, and they don't understand the people running the economies. And that's a major contribution to getting a bad result and a bad analysis. But secondly, Philip, I just wanted to take you up on this issue of rates of return in Africa. Yeah. Totally disagree. Right. The rates of return on investments in Africa are much higher than in Europe and even Asia and Latin America. The reason why they're high is linked to this issue of ratings agencies. It is the Africa premium. Someone will not commit funds to Africa unless they're guaranteed a profit perhaps double of what they're getting in a developed country market. So I think that has to be taken into consideration. And most of the private sector investments in Africa are extractive. They're in the natural resource sectors, oil, gas, mining, and that's why they're profitable. And they're super profitable. Of course, there are volatilities in the markets, we all know, but essentially they're profitable. There are very few, unfortunately, very few impact good investments going on at the moment, purely in terms of the social impact they have. I mean, I'm afraid that is the reality.
And maybe, Agnes, over to you about the technical assistance and credit ratings. Any thoughts?
Yeah, so I think obviously as a DFI, it's part of our DNA, really in our DNA to, as you mentioned, and I fully agree with you, to create the environment so that the company in which we invest are successful. So first, part of our DNA, because it's impactful, obviously. So we do technical assistance on other topics than governance, but I think on FIs, this is really one of the key topics that we have focused on lately. But apart from that, obviously it's also, again, and comes back to my first point, it's also something that is good for return. So if you just give capital and do nothing aside from that, obviously your return rate will be lower than what you should expect. But maybe I want also to add one thing in how we invest in Africa. I think the difference for DFIs and maybe why we agree to take, let's say, more risks than others is that we are more patient. Typically when we invest we do invest in funds, for example, and we see that almost all African funds apply the standards that we see in Europe and in the US. So for example, it's the 10-year fund +1, extension +1. But when you actually look at some countries in Africa, it doesn't make sense. What differentiates DFIs from maybe more private investors is that we are patient and we agree to remain maybe 8-10 years in some institutions and wait for the return to come because they need basically longer horizon to be able to grow.
So very quickly, I fully agree with what Patrick said. First of all, returns in Africa are absolutely outsized versus anywhere else in the globe. So that's why people like to invest in Africa. We need to de-risk it. It's the credit rating agencies that make it very difficult to de-risk the investments into Africa because they actually don't see what's going on the continent. You know, we've even thought about putting a table together to look at African government default rates versus those across the globe and what rates have been given to them in terms of sovereigns by the various rating agencies, just to prove a point. So I think the agencies need to have people on the ground, need to understand what's driving the economies. And just to give you a very high-level example, the G7 average debt to GDP runs at 156%. The average debt to GDP in Africa is at 70%, and most countries are below 50%. So it's important to understand where Africa sits, despite the sort of weird stuff that we get in the press, which is totally ill-informed. And what really exacerbates this is that most of the credit rating agencies' staff have a very sort of Western view that they want to impose on Africa without ever having taken credit of what happens in Africa and how African governments operate and how corporates work in Africa. So I think it's important to understand that. So we need credit rating agencies really to join us on this journey.
Thank you, Mikael. Now, very quickly, Philip, final comment.
Just to clarify this point which I made about risk-adjusted returns. I don't deny that there's fantastic investment opportunities on the African continent, but one who needs to go with open eyes into it. For example, if you look at Nigeria, you can have an ROE of 20% or 30% per year, but your return will be eaten up by currency devaluations. So that's what we need to be aware of. Then, of course,
Sorry, Philip. I'm terribly... Excuse me, I think we need to finish by now.
Yeah.
But I'd like to thank the audience and our panelists for a very interesting debate, and I encourage everyone to invest in Africa. Thank you. Sorry, Philip.